All right, turning back to the markets, with the markets kind of technically mostly to the downside here this morning. Let's get some insight on early morning trading. And with that, I'm joined by Thomas Hayes, chairman of Capitol Hill, Greater Hill Capital, excuse me. The S&P has been up over 3% in the last 2 weeks, kind of making some solid gains. I think the Dow kind of in the same boat there. I'm curious, do you anticipate stocks are going to remain or become more resilient in the months to come? And what do you see as kind of the biggest near-term risk to the markets?
Yeah, well, Alicia, thanks for having me on. There's been a lot of talk, particularly when the market was down before the big rally, that a recession is imminent. And our base case is that we're not headed for a recession. The good news is we don't even have to predict it, Alicia. We can leave our crystal ball in the closet because the market will signal when we're going to have a recession by the inversion of the 2-10 spread of U.S. Treasuries. Once that gets to zero, what you see is credit gets choked off in the economy. And on average, 16 months later, you have a recession. Most people think it's time to sell when you have an inversion. It's actually been a buy signal for the last handful of cycles. The steepest part of the equity rally is often after the inversion and before the recession. So you get about a 6 to 18 month lead time on average where you get further gains, and we haven't even inverted yet. So I think what you're going to see with the Fed in the May meeting is that they'll probably continue with their steady 25 basis point hikes every meeting, but they're going to shift to balance sheet roll-off. And what the balance sheet roll-off could do, particularly if they focus on the long duration securities in the portfolio, is re-steepen the yield curve, just like we saw in 1994 when the 2-10 spread got as narrow as 9 basis points. It's now about 18 basis points. You don't want it to get to zero. They were able to re-steepen the curve and extend the cycle by another 5 years. I think we could see a similar situation this time, that while we're pretty close to inversion at 18 basis points, they could re-steepen the curve by focusing on the right policy and extend the cycle for another few years. So we're pretty sanguine on the markets right now.
You mentioned the Fed. Your thought process is that come this May, we'll see a 25 basis point hike, if I've heard you correctly there. But over the past week, we've really heard a more hawkish Fed. I mean, Powell himself coming out seemingly more hawkish. We've certainly heard FOMC members kind of take a harsher stance. And the growing consensus, or there has been just momentum around a half a percentage hike come this May. Why are you a bit more dovish there?
Yeah, you just have to look at the data. So we're coming up on what they call high base effect. If you remember, around this time last year was when inflation really started to spike. So what we saw in last month's report was that wage inflation came down. Average hourly earnings were less than expected in last month's jobs report. We think we're going to see a similar situation in this month's jobs report. And that's going to be a huge factor. We're seeing the Cass Freight Index rollover, which is a leading indicator that we should see an alleviation of inflation pressure for goods towards the second half of the year. So the question is really just the timing, if they can get this in place quickly enough moving forward. So looking at inflation, we see oil right now is it looks like it's peaking out. If you look at the rig count is up 164% off of its lows. You look at commercials in the commitments of traders report on a weekly basis, they're starting to sell, and they tend to be a leading indicator. And then we saw over the weekend, potentially with Russia now just focusing on the Donbass region, we could get a negotiated settlement. That would bring some air out of the oil prices, which would lead to the U.S. and Iran deal potentially pushing through, and that could lead to another 1 million to 1.8 million barrels per day put on the market over the next 6 months. So a lot of things are lining up. While everyone's been chasing into oil, you could see a lot of air come out of that pocket. And the inflation numbers of late have been driven by used car prices, which have started to roll over, and everything else energy, which there are some catalysts here in the near term, including the rolling shutdowns in China that can alleviate some demand in the short term.
Well, I think the good news in your thesis, if it ends up being correct, is that we could be peaking at inflation. And I think for the consumer side of things, everyone wants to hear that. And I even think on the business side, obviously, so many companies just paying so much more for commodities, and the cost of doing business has risen drastically. We'll see who's kind of right in that camp. Want to pivot to the energy markets, as you touched on that. Energy market, that's up, 42% year to date. The UAE says that's going to work with OPEC Plus to stabilize the oil markets. However, we have factors like Russia's invasion of Ukraine. That's still certainly something that's top of mind for a lot of people, and uncertainty there. Then you've got the COVID-related lockdowns that we're seeing in China, the world's largest kind of crude importer. How does this impact your overall outlook on the oil and gas industry, albeit you saying there a moment ago that you think we could be peaking there?
Yeah, what you saw, just in terms of stock market positioning, Alicia, 2 years ago in 2020, we were aggressively talking publicly about buying energy when no one wanted them. In the last couple of months, what you'll notice is all the people who hated energy stocks in 2020, now that they're up 200 and 300 and 400%, in some cases more with the small E&P names, now everyone is crowding into cyclicals, into energy, into banks after they've already made their moves. And usually when it gets that crowded to one side of the boat, something changes, whether it's those four factors that we were talking about, that rig count creeping up, the commercial selling ahead of it, a negotiated settlement, or an Iran deal, where it opens the trap door for the Johnny-come-latelys. And you could see a big drop in oil and some of these stocks moving forward. So I think that's going to help. Inflation and consumer confidence are joined at the hip. So we're going to see the Consumer Conference Board numbers, the consumer confidence numbers on Tuesday. While they'll be elevated here, it may be the last time that we see the consumer so lacking confidence. Moving forward, as inflation comes down, we'll start to see better numbers.
With all that, then I have to ask before I have to let you go here. Where do you anticipate consumer behavior and consumer spending that changing in the next couple of months? Do you anticipate that they're going to remain strong and kind of, continue spending at the rate that we've seen the consumer spend over the last, 2 years? Or do we see a pullback?
Yeah, never underestimate the power of the U.S. consumer. What we're going to see is a big shift, Alicia, and we're starting to see it from goods to services. We're going to have revenge travel. We heard from Target, they said their two biggest sellers are suitcases and swimsuits. People are traveling. We're seeing it in the TSA numbers at 90% of the travel rate of 2019. That's before business travel comes back. That trend is going to persist regardless of energy prices, and that's a good thing for the consumer. It's a good thing for the economy, and it's a good thing to bring down prices on goods, which certainly we had the issues with the supply chain bottlenecks of late. Those are starting to ease up moving forward.
All right, a bullish take today from you, Thomas. Really appreciate your insight. Thomas Hayes, chairman of Great Hill Capital.